All right, welcome to the deep dive. We've pulled together a stack of sources today that really show just how interconnected everything is right now.
Yeah, absolutely.
We're looking at, recent shifts in global economics, the sometimes, thorny debates around trade policy,
Hmm.
a really critical global debt crisis that's unfolding, the cutting edge of sustainable finance, and those ever-present challenges in supply chains.
And these might sound like, totally separate topics, but what the sources make really clear is they're all tangled up together.
Definitely.
So our goal for this deep dive is to try and untangle them a bit for you, pull out the most important nuggets of knowledge, and give you a clear, sort of well-informed picture of what's happening.
And what's coming next,
Thanks,
right,
yeah.
in this complex global landscape.
Exactly.
Think of it as getting the essential insights, maybe some surprises too, without having to dig through everything yourself. Let's unpack this. So we're starting with the global economic pulse, and here's maybe the first big finding from our sources on the U.S. economy. Despite a lot of uncertainty heading into 2025,
Right. Tariffs, trade, tax changes, all that
full of
stuff.
all that noise, the first half of the year actually showed, surprising resilience according to this data.
That's right. I mean, growth wasn't, setting the world on fire in the first quarter, but the data we have suggests Q2 is pacing to exceed 3%.
And what was behind that?
Well, according to the sources, it was largely household consumption. People were still, buying things,
Yeah.
spending.
And the job market held up better than a lot of people expected, too. Unemployment's been hovering around, 4.2%?
Yeah, and one source had an interesting description. It called it a market where companies aren't hiring like crazy, but they're also really, really reluctant to let people go.
Hanging on to the talent they've got.
Exactly. Low hiring, low firing.
And wage gains look pretty decent, too. Around 3.9% year over year in May.
Yep. And crucially, this has actually been outpacing inflation. Consumer prices up about 2.3% in May.
Okay.
And that core PCE deflator, the one the Fed watches really
Yeah.
closely because it strips out food and energy,
Mm.
that was 2.5% in April.
Mm-hmm.
Both of those inflation numbers actually hit multi-year lows.
Sure.
So inflation seemed pretty contained in the first half.
Although, one source did point out something kind of interesting about those job numbers.
Oh, yeah?
While the establishment survey, that's the one tracking company payrolls, shows that wage growth and the cooling hiring you mentioned,
Right.
the household survey, which asks individuals, actually showed a pretty significant drop in employed people and labor force participation, too, back in May.
That discrepancy is definitely worth noting. It could just be, statistical noise, sometimes happens month to month, or it might, just might, suggest some underlying weakness. Maybe some early impacts from all this trade uncertainty that aren't fully showing up in the employer data yet. Something to watch.
Okay, so looking ahead, second half of 2025. The sources flag potential impacts from a possible U.S. tax bill.
Yeah, things like extending parts of the Tax Cuts and Jobs Act,
Mm.
maybe speeding up deductions for capital expenditures, potential deregulation,
Could influence companies.
could influence corporate decisions, yeah.
Yes.
Though maybe more of an impact felt in 2026, depending on timing and details.
And the big question, always, interest rates. What are the sources saying about the Fed?
Well, it's interesting. The futures market, it initially priced in fewer rate cuts by the Federal Reserve.
Right.
But the sources we looked at still suggest one or maybe two cuts are likely this year.
And why is that?
Because the Fed funds rate, where banks lend to each other overnight, it's still quite a bit above where inflation's running. There's room, potentially.
Okay, let's hop across the Atlantic, the Eurozone. Very different inflation story there right now.
Yeah, quite different. Consumer prices were up only 1.9% in May. That's the lowest since September of last year. And core inflation there, even lower, 2.3%, a level they haven't seen since way back in October 2021.
So things really cooling off.
Seems like it. Services inflation is easing, and prices for non-energy industrial goods, they're barely moving. Just a 0.6% increase.
And you see that trend across the board. Germany, France.
Yeah, pretty widespread. Germany, France, Italy, Spain, Belgium, the Netherlands, similar patterns.
And unlike the U.S. Fed, the European Central Bank, the ECB, they've already started cutting rates.
They have cut rates by 25 basis points. That's 0.25%, just as expected. And actually, they've cut a total of 200 basis points, 2 full percentage points, since June 2024.
So that's creating a bigger and bigger interest rate gap between the U.S. and the Eurozone.
It is. And normally, you'd expect that to weaken the euro, right? Make European exports cheaper.
But
sources note the euro's actually been rising,
yeah.
strengthening.
Huh. Why is that happening?
Seems to be partly due to global investors showing maybe a bit less enthusiasm for dollar assets right now. Aversion, maybe?
And a stronger euro actually helps keep Eurozone inflation down.
Exactly. It makes imports cheaper for them. Plus, you've got weaker energy prices, possibly linked to fears about trade wars, also helping suppress their inflation.
So you've got these opposing forces. Declining rates could boost the Eurozone economy.
Right, especially if governments increase borrowing for things like defense spending, which is happening.
But the big risk highlighted is trade.
Yeah, uncertainty from potential U.S.-EU trade disputes. That's the shadow hanging over things. It could easily undermine any potential growth spurt.
Okay, one more quick stop on the global tour. Japan. And some really striking demographic data coming out of there.
Yeah, this really jumped out. The number of live births in 2024 hit a record low going all the way back to 1899, down 5.7%.
And the surprising part?
The government expected birth rates to get this low eventually, but not until 2038.
Wow, so it's happening way faster than they thought.
Years faster. The fertility rate is now just 1.15. You need about 2.07 just to keep the population stable without migration.
Which means
Profound implications. Population decline is speeding up. And the labor force, the number of working-age people, is projected to shrink significantly from 2035 onward.
how much shrinkage are we talking?
From about 69 million people down to under 63 million by 2050. That's a big drop.
And that puts enormous pressure on government finances,
Right.
especially pensions.
Huge stress.
Yeah.
So what are the potential solutions the sources mention? Well, one is boosting labor productivity. Maybe companies invest more in automation as labor gets scarcer and costlier.
Makes sense.
The other is increased immigration. But the numbers so far have been pretty modest. It's a really rapidly unfolding demographic challenge for Japan.
Okay, let's pivot now to the complex world of trade and tariffs, which, as we've seen, is tied right into these economic pictures. Our sources give a pretty helpful primer on the U.S. trade deficit. It's often misunderstood.
It really is. So, put simply,
Right.
the U.S. buys more goods from other countries than it sells. That's the merchandise trade deficit.
But it sells more services than it buys.
Right, there's a services surplus. But overall, when you net everything out, goods, services, a few other bits, the U.S. buys more globally than it sells. That's the current account deficit.
Okay, so if the U.S. is sending dollars out to buy things,
Foreigners end up holding those dollars, and what do they do with them? Mostly, they invest them back into the U.S.
buying things like U.S. government bonds or property or company stocks.
Exactly, buying
Yeah.
U.S. assets. And that inflow of money creates what's called a capital account surplus.
And here's the key point from the sources.
The arithmetic, yeah. That current account deficit and the capital account surplus, they have to almost perfectly offset each other. It's a balance of payments thing. It has to balance.
So the question the sources pose is this trade deficit automatically a bad thing?
Right, and the argument presented is maybe not necessarily.
Mhm.
This net inflow of capital into the U.S., it adds to domestic investment. It helps keep borrowing costs lower than they might otherwise be. It can contribute to economic growth.
So if you call it a capital account surplus, it sounds pretty good.
Exactly. Maybe the negative vibe just comes from the word deficit.
When can it be a problem, though?
Well, sources say it can become problematic if a country racks up excessive external debts, owing too much to foreigners. That's generally less the case for the U.S., given the dollar's role.
And it's connected to the U.S. government's budget deficit, too, right?
Very closely connected. A large budget deficit needs financing. Someone has to buy those government bonds. And foreigners buying U.S. bonds is a big part of that inbound investment, that capital account surplus.
So if a government borrows more?
Often, yeah. The current account deficit needs to increase, too, if foreigners are the ones doing more of the lending to finance that government borrowing. It's linked.
Are there concerns mentioned about this reliance on foreign capital?
There are concerns that foreigners might become less willing to hold U.S. bonds someday.
Yeah.
That could push up U.S. borrowing costs, maybe push down the dollar's value.
Though others argue.
Others argue these capital inflows actually push the dollar higher, which hurts U.S. manufacturing competitiveness. But then the counter is that the dollar's global reserve status is what keeps U.S. borrowing costs low and attracts all that valuable investment in the first place. It's complicated.
Okay, let's get into the recent trade policy fireworks, particularly with the EU.
Yeah, quite dramatic. Sources detailed the proposed 50% tariff on all EU imports.
And President Trump was quoted saying talks were going nowhere.
While Treasury Secretary Bessent suggested the proposal was maybe intended to light a fire under the talks, get things moving.
But those tariffs were then postponed until July 9th for more talks.
That's right. Perhaps because of negative market reactions or maybe some constructive signals behind the scenes, but the pause is temporary.
And the U.S. still has existing tariffs on EU imports anyway.
Oh, yeah. 10% generally, plus higher rates on some specific goods. And the EU is absolutely ready with retaliation measures if a deal isn't reached by the deadline.
This is huge trade we're talking about. What were the numbers?
Massive. $606 billion in imports from the EU in 2024. Think pharmaceuticals, cars, huge categories.
And U.S. exports to the EU?
$370 billion. So there's definitely a gap there, which the administration is focused on. Although sources do point out that just looking at the imbalance between two specific countries doesn't necessarily tell you much economically in isolation.
So what is the U.S. actually trying to get from the EU in these talks? It's not lower tariffs, you said?
No, tariffs are already pretty low on average, around 2.7%. It seems to be more about non-tariff barriers.
Like what?
Well, value-added taxes, VATs, are mentioned. But sources argue those apply equally to domestic and imported goods, so they aren't usually seen as discriminatory barriers.
Okay. What else?
Discriminatory regulations, that's another point. And currency manipulation is raised. But again, sources say the ECB operates independently and isn't really manipulating the euro for trade advantage.
And just reducing the size of the trade gap itself.
That's a tough one. The EU as an entity doesn't really have the authority to just, commit to buying more U.S. stuff. Maybe they could tweak government procurement rules, say for defense equipment, but fundamentally changing the overall trade balance is hard for them to promise.
So sources sound a bit skeptical about a comprehensive deal?
They make it sound challenging to see how a deal could fully satisfy all the U.S. demands, but maybe a smaller face-saving agreement to avoid major market disruption, that's not impossible.
And then there's this whole legal angle playing out in the courts.
Right, adding another layer of complexity. A U.S. Court of International Trade recently ruled that most of the Trump administration's tariffs were actually illegal.
Illegal how?
The court said the administration overstepped its authority. They used a law, the International Emergency Economic Powers Act, i.e. EPA, that's meant for genuine national emergencies.
And they claimed the trade deficit itself was an emergency.
Pretty much. But the court rejected that. They said, look, trade deficits have existed for decades without causing clear catastrophic damage. It doesn't meet the bar for an unusual and extraordinary threat that the law requires.
And if that ruling is upheld?
It would be huge. It wouldn't just cancel the tariffs going forward. It would require the government to refund potentially billions already collected.
So what happens now?
Well, the administration immediately vowed to appeal, and an appellate court has allowed the tariffs to stay in place while the appeal happens. So it's ongoing.
Are there other ways the administration could try to implement tariffs if they lose the appeal?
Sources list a few other laws they could potentially try to use, but they all have limitations. Some are only temporary, some require specific findings like national security threats, which can be slow, some are for specific discriminatory practices.
And getting Congress to just change the laws to give them more power.
Seen as highly unlikely in the current political climate. So yeah, it's a complex legal battle running alongside the policy negotiations.
Are we seeing any impact from all this uncertainty in the actual economic data yet?
We are, yeah. Some early signs. U.S. goods imports in April fell at the fastest pace on record.
Wow. How much?
Down nearly 20% nominally from March. Across almost every single category, exports were up just slightly.
So the trade deficit shrank sharply, which is what the administration wanted.
It aligns with their stated goal, yes. But, and this is a big but, from the sources, there's a crucial nuance here.
Which is?
For the trade deficit to fall sustainably, without just causing economic pain, one of two things needs to happen. Either Americans need to save a lot more, or foreign investment flowing into the U.S. needs to decline.
Because otherwise...
Otherwise, if the deficit falls simply because the economy weakens and people just buy less stuff overall, well, that comes at an economic cost. It's not really a win.
And the April data on personal income and spending, did it reflect some of that caution?
It seems like it might have. Real income for Americans was actually up in April. But real consumer spending increased only slightly.
And spending on goods specifically?
That actually fell, down 0.2% in real terms. Durable goods like cars, appliances down even more, 0.8%.
Why the drop in goods spending? What do the sources suggest?
Couple of possibilities mentioned. One, maybe people did some anticipation buying in March, trying to get ahead of potential tariffs so demand was pulled forward,
Hmm.
or maybe consumers are just genuinely getting more cautious because of all the economic uncertainty swirling around. We did see the personal savings rate tick up in April, hitting its highest point since May 2024.
So people are holding back a bit.
Seems that way.
This whole situation sounds like a real headache for the Federal Reserve.
Oh, definitely. It presents a challenge. Because on one hand, underlying inflation, especially that core PCE measure at 2.5%, is relatively low and has been falling.
And goods prices themselves actually dropped year over year.
Yeah, goods prices fell 0.4% year on year in April. Services inflation is still rising, but even that's at its slowest pace in years.
So underlying inflation looks contained.
But on the other hand, you have all this uncertainty and the very real potential for higher tariffs to be implemented, which would risk pushing goods prices up again.
So they're caught between low current inflation and future tariff risks.
Exactly. It's a tight spot for policymakers trying to decide on interest rates.
Okay, looking ahead then, second half of 2025, trade uncertainty is still the name of the game.
Remains a key factor, absolutely. With China, sources say a framework for discussions has been established, potentially including some tariff adjustments, talks on non-tariff issues like access for rare earth minerals, maybe jet engines. But it's a relationship still very much under construction.
And with the EU and other partners, that July 9th deadline.
It's looming, yeah. But sources suggest an extension is probably likely if talks are seen as happening in good faith. These kinds of trade deals and adjustments, they just take time.
So the overall outlook from the sources isn't necessarily doom and gloom on tariffs.
The sense is that maybe the absolute highest rates that were initially floated, like that 50% on the EU, might be avoided. Uncertainty persists, for sure.
But average tariff levels are still expected to be higher than they were at the start of 2025.
Substantially higher, yeah. The sources suggest moving from maybe around a 2% average overall tariff rate up to potentially 10% or more, and then much higher on specific goods or imports from countries like China.
And the potential economic impact of that.
Well, higher tariffs generally mean higher goods prices. That weighs on inflation, and it could slow down consumption growth a bit.
But you have to remember.
You have to remember the structure of the U.S. economy. It's hugely services-driven. About 72% of GDP comes from services, compared to only about 28% from goods.
So the impact of tariffs just on goods is somewhat limited for the overall economy.
Exactly. Plus, companies aren't passive. They can use inventories, they can try to diversify suppliers, they can absorb some of the costs themselves, at least for a while.
So bottom line, trade friction is a headwind, but probably not enough to cause a recession.
That seems to be the view from these sources. They still expect positive economic growth overall, maybe slightly below recent trends because of this friction, but likely avoiding a downturn.
Okay, let's shift gears now, moving from the economic and trade picture to something much heavier, the weight of global debt.
Yeah, this is a really sobering section in the sources. One, from Jubilee 2025, calls this a new global debt crisis, and they frame it as the most acute in history.
The most acute ever. That's a strong statement.
Yeah, it is, but the numbers they present are stark. Over 50 countries, that's 1 out of every 4 globally, are currently in debt distress.
And the number's gone up.
Doubled since 2015.
Yeah.
And many, many more are considered at high risk.
What triggered this crisis?
It seems to be a combination of factors hitting vulnerable countries hard since 2020. The economic shocks from COVID-19, the fallout from the war in Ukraine driving up food and energy prices, and then the big spike in global interest rates, making existing debt much harder to service.
And the human cost is huge.
Immense. The sources point out that 3.3 billion people, that's nearly half the world's population, live in countries that are now spending more money paying interest on their debt than they spend on essential services like healthcare or education.
More on debt than health or education.
Yeah, and get this statistic. 93% of the countries considered most vulnerable to climate change are also facing a debt crisis.
Wow.
They're spending, on average, 5 times more servicing their debts than they're spending on measures to adapt to or mitigate climate change, even as they're getting battered by floods, droughts, famines, all linked to climate change.
It's a vicious cycle.
Completely. And for countries already struggling with food security, the sources say debt servicing costs shot up by 75% recently. It's making basic necessities completely unaffordable for millions.
And this is leading to instability.
The sources directly connect this debt pressure to the widespread protests and even riots we've seen across many countries in the global south, places like Kenya, Sri Lanka. People are desperate.
Where did all this debt come from? How did things get so bad?
Well, the sources trace some origins back to debt as a legacy of colonialism.
Oh, so.
Newly independent nations often either inherited debts from their colonial rulers or had to borrow heavily, often from those same former powers, or from international institutions dominated by them, creating this ongoing dependence right from the start.
And these international financial institutions like the IMF, World Bank, they play a role.
They're critiqued in the source for being dominated by the creditor nations, the lenders, meaning the low-income borrowing countries have very little say in the rules.
And the rules often favor.
Prioritizing debt repayment above almost everything else, these institutions often pressure debtor nations to cut spending on healthcare, education, infrastructure, even things that could help them develop their own industries long-term, just so they can keep making loan payments.
Austerity measures tied to bailouts.
Exactly. And these austerity policies are highlighted as actively worsening human suffering. The source mentions specific examples from just this year, 2024, of governments being forced to cut things like electricity subsidies or other vital services to free up cash for debt payments.
And does this approach even work in the long run?
The critique is that it traps countries. It stifles development, leaves them constantly reliant on more foreign credit just to stay afloat. The fact that countries like Ghana or Sri Lanka have needed multiple IMF bailout packages over the years is used as an illustration that the current system isn't really breaking the cycle of debt.
What about private lenders? Banks? Bondholders?
That's another major driver mentioned.
Yeah.
Many low-income countries are now heavily indebted not just to governments or institutions, but to private lenders,
And they charge higher interest.
often sky-high interest rates, demanding quick repayment. And crucially, without strong international rules, these private creditors often refuse to participate in debt relief efforts when a country hits crisis point. They keep demanding payment.
Is there any way to compel them?
Well, it's noted that something like 90% of the poorest countries' private debt contracts are governed by English law. So there are suggestions, for example, for the UK to pass a debt justice law that could potentially cap the excessive returns these lenders can make when a country is clearly in distress.
Has there ever been successful large-scale debt relief before?
There has. The source points to the historic Jubilee 2000 campaign as a major success story.
What did that achieve?
It resulted in about $130 billion of debt being canceled for 36 heavily indebted poor countries. And there's tangible proof it made a difference.
Like what?
Primary school enrollment in those countries jumped significantly, from 45% up to 66%, because money saved on debt payments was actually redirected into public services like education.
But the soul says.
The critique is that while Jubilee 2000 canceled debt, it failed to fundamentally reform the system that created the debt in the first place, which is why we're now seeing this renewed crisis, and according to the source, it's even worse this time.
The case studies mentioned really bring home the human impact, don't they?
They really do. Sri Lanka, for instance, defaulted on its sovereign debt in early 2022, plunged into a severe economic crisis.
What did that look like on the ground?
Sources quote heart-wrenching accounts. Families having to choose which child could afford the bus fare to go to school because fares tripled. Hospitals running out of basic essential medicine. Widespread food insecurity. People literally going hungry.
And Kenya.
In Kenya, a staggering 73% of people are reported to be in severe financial distress or just unable to make ends meet. The government's turning more and more to those private creditors.
The ones with the high interest rates?
Yeah, they hold over a third of Kenya's foreign debt now, charging rates sometimes over 10%. Activists quoted describe the devastating consequences. Roads literally collapsing from lack of maintenance, tragic reports of children dying in hospitals because they lack basic medicine or equipment. It's brutal.
Sierra Leone, too, mentioned with currency collapsing.
Yeah, its currency lost half its value in just 1 year, 2023. That fueled hyperinflation, making imported necessities, food, fuel, medicine, completely unaffordable for ordinary people.
You hear directly from people affected.
Yes, there's a quote from Amy Callan, a small trader and farmer, just talking about how skyrocketing prices make it incredibly hard to feed her kids, let alone afford school fees. And all this while, the government's massive debt burden just cripples any ability to invest in public services.
Leading to terrible outcomes like high child poverty and infant mortality.
Nearly 70% child poverty, infant mortality, around 1 in 10 children under 5 dying. It's a direct consequence, the source argues.
So, given this grim picture, what are the proposed solutions? How do we get towards a fair and functional debt system?
The sources outline 3 core principles that should underpin any reform. First, the primacy of human rights, environmental protection, and development goals. These should come before creditor claims, not after.
Okay. Second.
Second, the participation of all creditors in any debt relief process. That means private lenders, multilateral institutions like the IMF and World Bank, and government lenders. Everyone has to be part of the solution. No exceptions. Fair representation for both debtors and creditors in the process. It shouldn't just be the lenders dictating terms. The source suggests maybe UN oversight could help ensure a more balanced playing field.
Are there specific mechanisms suggested? Like, how would this work in practice?
Yes. One key area is reforming how the IMF assesses whether a country's debt is sustainable.
How would that change?
Instead of just looking at whether a country can technically make its payments, the assessment should also consider the government's capacity to provide essential services, health, education, and invest in its own development while servicing debt. The ability to pay shouldn't trump the ability to function as a society.
And more transparency.
Exactly. Make the definitions of debt sustainability public, and maybe lower the threshold for declaring a debt unsustainable, triggering relief sooner.
What about sudden shocks, like climate disasters?
Another specific proposal is automatic debt cancellation, or at least suspension, when countries are hit by catastrophic events. Think major climate disasters, pandemics, severe economic crises.
Like Hurricane Beryl hitting the Caribbean recently?
Precisely. The sources note that even after devastation like that in 2024, small island nations were still being forced to make debt payments. Automatic relief in such cases seems essential.
Beyond specific debt mechanisms, are broader reforms needed?
Definitely. The sources talk about reforming the global financial system itself, finding ways to increase fiscal space so countries don't need to borrow so much in the first place.
Oh.
Things like reforming the global tax system to curb tax evasion and illicit financial flows out of developing countries, creating fair trade agreements, making those international financial institutions more democratic, giving developing countries a real voice.
And finding non-debt ways to finance development.
Yes. Special drawing rights, or SDRs from the IMF, are mentioned as a crucial tool here. They're essentially a reserve asset that can provide liquidity without creating new debt. More use of SDRs is advocated.
What about the counter-argument that reforming debt rules or canceling debt will just scare away future investors?
The sources tackle that head-on. They argue the opposite is true. A chaotic, crisis-prone debt system is what scares away good, long-term investment. A stable, functional, fair debt system actually creates a more predictable environment that attracts responsible investment.
And it strengthens economies?
It strengthens economies, improves their creditworthiness over time, and as we saw with Jubilee 2000, the evidence suggests money saved from debt relief does get spent on vital public services like schools, benefiting the population directly.
What about corruption? Does money just get siphoned off?
Corruption is always a concern, the sources acknowledge. But they argue it's incredibly difficult to tackle corruption effectively when a country lacks the basic structures for development and stability because it's crippled by overwhelming debt. Building those structures requires resources, which debt relief can help provide.
Okay, that's a heavy but crucial topic. Let's transition now to something that aims, perhaps, to be part of the solution for future development: sustainable and green finance.
Right. A source from Frontiers discusses its potential role in actually advancing the Sustainable Development Goals, the UN's goals on poverty, climate, equality, etc. Though, interestingly, this source also points out a gap in the research. We don't know enough yet about how green finance really impacts the most vulnerable communities or lower middle-income nations.
So a need to focus implementation there, especially given the debt crisis we just discussed.
Exactly. There's a critical need to make sure green finance actually reaches and benefits low-income regions that are often on the front lines of climate change and debt distress.
China's experience is presented as a case study.
Yeah, a pretty fascinating one. They've made a very deliberate shift over the years, moving away from a pure growth-at-all-costs model.
Which they had for decades after reforms started.
Right. Towards integrating sustainable practices much more deeply into their economy. This really picked up steam with the concept of ecological civilization they introduced around 2012. That catalyzed the development of their whole green finance framework.
And China's seen as a leader in this space now.
This source portrays them as a global leader, in trying to balance economic growth with environmental sustainability. And they also support international climate efforts, like South-South cooperation, helping other developing nations.
What are some concrete examples of China's green finance in action?
Well, the rapid growth of their green bond market is one big example. That money gets channeled into specific projects.
Like?
like building eco-industrial parks, retrofitting buildings to be more energy efficient, bringing renewable energy sources into industrial processes.
So real-world projects.
Yeah, and significant investment in new energy sectors, solar, wind, and green transportation projects. These are highlighted as directly contributing to goals like SDG 7 on affordable and clean energy and SDG 13 on climate action.
What policy recommendations does this source offer for fostering green finance more broadly? Maybe lessons from China or elsewhere?
Creating the right environment for green investments is key. That means having robust regulatory frameworks in place.
Rules of the road.
Exactly. Clear guidelines and standards for labeling financial products as green. You need to define what actually qualifies as a green project, ensure transparency, and avoid greenwashing, where things look green but aren't really.
What else helps?
Facilitating public-private partnerships, especially for big, large-scale renewable energy projects. And providing incentives, things like tax benefits or subsidies, to encourage private capital to flow into green sectors.
Okay, so from finance to the physical movement of goods, let's look at supply chains. They've certainly been in the headlines the last few years.
Oh, absolutely. We've seen incredible volatility from 2021 through 2024. Port congestion, labor issues, wild weather events, geopolitical disruptions, like everything happening around the Suez Canal. It's been chaotic.
And what are the sources saying about the key challenges expected specifically for supply chains as we look into 2025?
Well, first off, that broader global economic uncertainty we started with. Fluctuating oil prices, unpredictable inflation, and especially those shifting trade policies we just spent time on.
Makes planning hard.
Really hard. Financial forecasting, deciding how much inventory to hold. Very tricky.
Geopolitics still a major factor.
Huge. Shifting geopolitical relations remain a top concern. President Trump's proposed tariffs are mentioned specifically as something companies need to watch very closely and be ready to adapt to. Flexibility and strong partnerships in different regions are crucial.
What else?
Regulatory compliance. Just keeping up with different rules in different international markets is getting more complex. Requires good automated tracking systems and really proactive monitoring.
And sustainability. Is that becoming unavoidable?
Undeniable urgency around sustainability now. It's being driven by ESG goals, by actual regulations coming into force, by consumers demanding it, and by investors demanding it.
So companies need transparency.
Total transparency on their environmental footprint. And they need to adopt genuinely sustainable logistics practices, things like optimizing delivery routes, using renewable energy in warehouses and transport.
Consumer demands are changing too.
Constantly evolving. People want faster delivery. They want more transparency. Where did this product really come from? They want customization. And increasingly, they want sustainable options.
Which requires
Better technology. Real-time tracking, personalized service offerings, sophisticated analytics to forecast demand better, and manage inventory more efficiently.
What about labor? Still seeing shortages.
Still a major issue mentioned in the sources, especially for truck drivers and warehouse workers in many regions.
Driving interest in automation.
Definitely fueling interest in automation and AI solutions.
Yeah.
But it also highlights the need for companies to just improve working conditions and compensation to attract and retain the human talent they still absolutely need.
And cybersecurity with
Yeah.
all this tech.
Big risk. As supply chains become more digitized, the attack surface grows, so companies need to invest heavily in robust cybersecurity measures, do regular audits, train employees, maybe collaborate with security experts.
Okay, so lots of challenges. How do you tackle them? How do you build a supply chain that's actually resilient?
The strategies presented really emphasize fostering resilience itself as a core capability,
Meaning?
meaning being flexible, adaptable, being able to make strategic pivots quickly when conditions change, having solid contingency plans, having flexible financing options to weather disruptions, just being able to adjust.
Technology is key, obviously.
Non-negotiable, really. Embracing cutting-edge tech like AI, the Internet of Things, IoT, predictive analytics. These are crucial now.
For what specifically?
Better inventory management, much more accurate demand forecasting, automating routine tasks like order routing or warehouse management. It all enhances visibility and adaptability across the entire network.
And defenses.
Fortifying those cyber defenses is paramount. Robust measures, regular training, protecting data and systems has to be a priority.
What about where things come from? Sourcing.
Critically important. So diversifying sourcing and fulfillment. Don't rely on one single factory or one single country for critical components or materials.
Build partnerships.
Build global and local partnerships. The sources mention using specialized logistics providers, sometimes called 4PLs, who can manage complex networks, spreading the risk geographically.
And having backups.
Yeah, identifying alternative ports or transportation routes, fail-safes for major potential choke points.
Hmm.
If one route gets disrupted, you need a plan B ready to go.
So ultimately, technology and partnerships are the keys.
That's the message. They are the driving forces behind transforming supply chain management today, building what people are calling the smart or truly resilient supply chain needed for the future.
Okay, so pulling all these different threads together, you really can see how global economics, those intense trade policy debates, the severe sovereign debt
The
crisis.
push for sustainable finance and the challenges in supply chains.
Yeah.
They are absolutely not isolated issues.
No, they're deeply intertwined, constantly influencing each other.
Yeah, trade policy uncertainty. It directly impacts economic forecasts, puts stress on supply chains.
That global debt crisis, it cripples development, it hinders climate action in the most vulnerable nations.
While green finance is simultaneously trying to unlock the funding needed for that very transition, it's paradoxical.
And just general economic conditions, booms or slowdowns, affect everything from how heavy the debt burden feels.
To consumer demand, which then creates either pressure or relief all the way down the supply chain. It's all connected.
So navigating this complex global landscape really requires understanding not just each piece on its own.
But how they interact, how they ripple across each other. Hopefully this deep dive into the sources has helped clarify some of those dynamics, maybe giving you some valuable insights.
It certainly paints a picture of a world in, well, significant flux. And that connection between the debt crisis hitting climate vulnerable nations hardest, while sustainable finance tries to pave a greener path, it really stands out.
Does
And it leaves us, I think, with a critical question to reflect on. How can these global financial structures evolve, not just to relieve crippling debt burdens after the fact?
but to actively enable sustainable development and climate resilience in the places that need it most from the start.
Exactly. What fundamental changes are actually required in these systems themselves to truly shift from constant crisis management to proactive, sustainable global progress? Something to think about.